Well, hello there, and welcome once again to module number 5. We're looking at the different financing options, and we've already looked in lesson number 1. We talked about the conventional financing. In lesson number 2, we're going to talk more about non-conventional financing. So, finance options we looked at in lesson 1 were the banks, credit unions, etc., as well as mortgage brokers. And this is what I'm going to call as conventional lenders or finance options. Today, what we're going to look at is the personal cash, lines of credit, or use of retirement funds, whether they be RSPs or 401s, as well as joint ventures, private money, as well as vendor take-back seller financing. Actually, the vendor take-back we're going to look in lesson 3. So this is all considered to be non-conventional, and that's what we're going to be focusing on here for this particular lesson. Now, when we talk about raising capital, I really want to stress that you need to be aware of the Securities Commission. You need to check what the rules and regulations are with respect to raising capital, dealing with individuals in your particular province or state. It will vary slightly from jurisdiction to jurisdiction. But generally speaking, what you want to do is just be aware of the rules so that you don't advertise looking for investors. So, for example, you don't place an ad on the internet, whether it be Craigslist, Kijiji, whatever the case. You don't place an ad saying investors wanted for land speculation deal. You also don't advertise that investors wanted 10% guaranteed returns. These are red flags to the Securities Commission, and they monitor these marketing mediums very, very closely. So they could be on you very, very quickly, and you could be just given a warning, or you could be facing some fines as well. So you definitely want to understand the rules and understand the difference between an accredited investor versus a non-accredited investor. I'll talk a little bit about that in a second. So to get a better handle on all of this, especially knowing that each jurisdiction is a little bit different, what I suggest you do is discuss this with your lawyer to get a very clear understanding of what you can or cannot do. Now, with respect to accredited, an accredited investor is somebody who has a net worth, or they've got assets worth $1 million before taxes and without any debt registered against it. So free and clear, not including your own personal residence. It could also include an individual who has debt on these properties, but now the value has to be over $5 million. So when you do the 80% loan to value, 20% of $5 million is going to net you that same $1 million. So that's one way to become an accredited investor. Now, if you don't have the assets to meet that criteria, yet you are a high income earner, so if you are an individual that earns in excess of $200,000 annually, you've done so for the past 2 years, and it's expected that you will in the foreseeable future, then you are accredited. It could also include a couple, 2 spouses who jointly make over $300,000 per year and has done so consistently in the past as well as in the future. So any of these individuals based on this criteria would be deemed to be an accredited investor. Now, you can use this as a guideline to help you identify people. It's to help you know who you can talk to about raising money and who you can't talk to. See, what happens is the law deems it that the investor who has the high income, the high net worth, lots of assets, they're better educated and better able to handle any potential losses should there be any. The other individuals who don't have the high income, if they were to experience a loss, they would be less likely to be able to afford that loss. Therefore, they are unaccredited investors. That's why the rules are designed to protect the unaccredited investors. So if you can identify and attract accredited investors, those high income earners, and there's lots of them out there, then basically you can say, do, promise whatever you want, as long as it's ethical and legal, of course. All right, so now different types of lending is going to be your cash. We always say that cash is king. It's great to be in a position to purchase a property with cash, either yours or somebody else's, simply because it gives you a much stronger negotiating ability. It's one less thing that you need to put in as a condition when you're purchasing a property. The fewer conditions, the better the leverage for you to be able to achieve what it is you're looking for, especially if it's a competitive market. There's lots of people looking to buy a particular property. If you can go in with as few conditions as possible, then you stand a better chance of achieving your goal. One thing I do stress or suggest you do is pay attention to the return on your investment though, and the lost value or the lost use of money. So by taking the money out of your account where you're earning 2 or 3% to put it into an opportunity to earn 5%, you're really only earning a difference of about 2 or 3%. You have to determine whether that's of value to you or not. Now, that's only on a cash flow basis. With real estate, you still have the benefit of the other profit centers, so most likely it is of value. But if you are investing all of your cash into an opportunity that's basically breaking even, you've got no cash flow positive out of it, and you're taking the money out of an investment that's paying you 2 or 3%, you're now in a negative position. So you just need to be aware of that. Also, having all of your money tied up into one property is not the best use of your money, especially today with the low interest rates that we are currently experiencing. You would be best to leverage that property with as much debt as you legally can. It's usually up to approximately 80% of the value of the property to get your money back out so you can buy more investment properties as well. But having that cash initially gives you a very strong opportunity to operate with that high leverage and able to convince the people to take your offer over somebody else's. Then you have line of credit. Now, line of credit is similar to having cash actually, because you have access to cash. And this line of credit may be secured against an asset such as your house or other assets you may have. It has to be a fixed asset though, not a car. That's not really a good asset, but it could be other investment properties, or it could be a cottage, for example. As long as it's secured by a good solid asset, and it's deemed to be secured, therefore lower risk by the lender, and they will charge you a lower interest rate versus having it unsecured, meaning that it's only secured by your word, your ability to pay that debt back based upon your credit history. This is why it's extremely important for you to maintain your credit history so that you have really good credit scores and you can show the bank that you pay your bills not only on time but always. You're never late. The difference in rates with a secured line of credit in today's market, where a mortgage goes for 2.5% to 3%, your line of credit would probably be around 3%. Secured line of credit would probably be around 3.5%, maybe 4%. Depends on the quality of the asset that it's registered against, as well as your credit history. When you look at an unsecured line of credit, that interest rate is going to jump from 4.5% up to 7, 8, maybe 9%, and it's going to the interest rate will be dictated by your credit report, your ability to pay the debt back. The higher you're deemed to be a risk, the higher the interest rate. Now, it's extremely important you understand that this is not a mortgage. It's very, very different than a mortgage. A lot of people treat and think the line of credit is a mortgage, and it's not, simply because you don't have any fixed terms or rates. What this is what we call a demand loan or a demand note, and the bank or the lender can call this demand loan in at any time, plus they can change the rates at any time as well. So you could receive a letter in the mail saying that in 30 days' time, the interest rate we're charging you is going from 4% up to 4.5%. There's no negotiating. It is what it is. You could also receive that same note saying that we expect full payment on this loan within 30 days. And that can leave you scrambling for some more money to pay off this demand loan, especially if you've got it used in an investment property. It's a great way to have some cash available sitting there ready to go so that you can go out and buy a property. What I would suggest you do is once you have the property under contract and you own it, I would then convert that line of credit into a mortgage, which cannot be called in unless you are in default. And this way you've got more security. Plus you'll have a slightly lower interest rate that's going to be locked in for the term as well. and then your line of credit is returned to you so that you can use it again for another property moving forward. Credit cards is another form or way to access cash. It's not a way that I would strongly suggest you use it. However, there are instructors, there are courses, programs out there that talk about this, using it on a regular basis. And I guess it depends on the market that you're in as well. For myself, the market I'm in, there's no way I could buy a house on my credit card, even with my high credit rating and the amount of cash I have available. However, I do know that there are some very depressed markets in both countries where you can actually buy a property on your credit card. I have seen it done. Actually, one of my students did it years ago. They bought an old rundown house for $10,000, and they were able to put it on their credit card. So it can be done, but I do not recommend you doing it. However, I do recommend that you have at least 2 or 3 good quality credit cards with high credit limits, and you want to have access to this cash because it can provide you with liquidity. If you need cash very, very quickly for an emergency, and this has happened to myself several times where I've accessed large chunks of money in a very short period of time, and it's nice to have that availability. The downside is that it does have high interest rates attached to it. So if you need to carry the debt for any length of time, it's going to cost you anywhere from 18 to 24% interest. And yes, you can get some credit cards with lower interest rates, usually for a short period of time, like an introductory credit card. But generally speaking, most credit cards are 18 to 24% fees, which can be very, very expensive. They also have potentially high annual fees when you go to renew the credit card or get the credit card. But on the flip side, those high fee cards usually provide other benefits such as travel points. So you have to decide whether you want the travel points, whether it's worth the high fees that you're paying or not. Credit cards are extremely important to help you build your credit worthiness extremely quickly as well. So if you're coming from a position of poor credit or no credit, then what you can do is actually go to a bank or a lender and you prepay a credit card, $500 or $1,000, and then you use that credit card as normal. At the end of each month, you pay that credit card off in full. The bank is happy to do that for you because you've prepaid it so that if you don't pay your bill, they know they've already been paid. So over the course of 6 months to 12 months, you'll see your credit score quickly start to climb, providing you are paying your bills on time and you're managing your credit card properly. Keep in mind that it can also destroy your credit extremely quickly if you cannot manage your funds and you don't pay your bills. If you allow the balances to carry over 60% of the value or what your credit worthiness is, meaning that if you've got the ability to borrow $10,000 on your credit card and you carry a balance of $6,000 or higher, then in the eyes of the credit card company, that's deemed to be irresponsible. Therefore, they're going to ding you on your points. So it's extremely important to understand all this and manage your credit card very, very well. Again, you only need 2 or 3 cards at the very most, but you definitely need to have a credit card in order to operate on day-to-day business. I mean, you can't rent a car without a credit card. You can't book a hotel room without a credit card. You can't do anything online without credit cards. So credit cards are a very important part of our life, and they can be a very important tool for you in the game of real estate as long as you use them properly. Another source of cash is retirement savings, and this is a huge source. It's virtually untapped with respect to real estate investing. Most people with retirement savings believe they have to invest them in the stock market, the mutual funds in particular, and they just hand it over to these portfolio managers and let them invest them on their behalf. What people don't realize is that you can actually invest your retirement savings in real estate through the form of a mortgage. This is done when you move your money into a self-directed fund, and that self-directed fund includes real estate mortgages. So yes, you can invest in real estate. So you can invest your own retirement savings. But I wouldn't suggest you do it because normally when you do your own, what you have to do is you have to put it in first position, and it needs to be insured as well. Therefore, it really doesn't make a whole lot of sense to take advantage of your retirement funds in your own personal property. However, you can invest them in other people's properties, and you can invest them in a variety of different positions. You can put it in first position, second, or even third position. And the beautiful thing about it is that you get to negotiate the rates and terms. So as long as the person who's lending the money to you is happy with the rates and terms that you're prepared to pay, all you simply do is you complete a worksheet saying this is how much I'm borrowing, and this is the rate I'm going to pay, this is how I'm going to pay it back, this is when I'm going to pay it back, this is the property it's going to be secured against. You provide all of these details to the lawyer, who then sends it off to the trust company to confirm that it's valid, and then the trust company instructs the lawyer to create the mortgage documents, and you're off to the races. There's very little, if any, qualifying at any time. I've done many of these types of mortgages. I have never had to personally qualify for any one of them yet. Nobody has ever asked me for my a credit report. What they are asking for recently is verification of the value of the property it's being registered against. So what they want you to do is have an appraisal created. Now, a good friend of mine from Spire Point Properties, his name is Paul Blackyer. He has created an online course to help you go through the process of using the retirement savings. Here in Canada, it's the RRSPs. In the United States, there are programs out there to help walk you through the process of doing the 401s. I just have not yet taken the time or found the time to find a program that I'm willing to put my name behind yet, but there are programs out there. Then there's the use of other people's money. Now, this can be done through a 50-50 partnership with just you on title and with the money partner as well, where the partner provides the cash and you provide the deal and the sweat equity. You both qualify and guarantee the mortgage. Now, the split can be whatever it is you want. I've put 50-50 down there, but it can be 40-60, it can be 20-80. It depends on your experience. It depends what you bring to the table. It depends how the money partner feels with respect to their confidence in you and or the deal as well. I would suggest, if you're just starting out and it's your first deal, in order to instill confidence and gain to gain respect and the confidence to do the deals yourself, you might want to do a 20-80 split, where you keep 20% of the profit and manage the property the whole bit, and you give 80% of the money to the investor. And then the next time around, now you've got some more experience, you can do a 70-30 split and work your way up to the 50-50 split. Then there's also doing the 50-50 partnership where you are not on title and the money partner is on title. So this can happen where you may not have a good credit rating, or actually right now in the financing or lending market, it's difficult for you to qualify for more than 5 mortgages in the residential world. So once you hit that threshold, you may not be able to qualify for any more mortgages, but you can still do deals by not being on title. So you find the money partner who's going to put up the 50%. They go on title. The challenge here is a lot of people say, well, how are my interests now protected? So what you do is you create a side agreement after the fact. The side agreement is what we call a co-tenancy agreement, where you both agree as to who is doing what, where the money's coming from, what's the exit strategy. If and when the property is sold, you're going to receive your share through the proceeds of the sale. And you do this after the property has been purchased and the mortgage has been placed on title. Now, there's still some risk here, because the owner of that property, the investor, could sell that property without you knowing about it and without you giving your approval. So the risk is that you lose the deal and any potential profits. However, the co-tenancy agreement does give you the right to go after the investor and sue them, but it's going to be on a personal level. So it's just a little bit more difficult. Then there's the 50-50 where you're on title and the money partner is not on title. This is pretty rare because most money partners want to have their equity registered so that they feel more protected. In this particular case, though, you're going to qualify for the mortgage. They may not have good credit, or they may simply want to keep it under the radar. They don't want it to show up in their portfolio at all. So this can be done for any type of property, whether it be commercial or residential, but that will dictate your ability to qualify. If it's residential, for example, again, you're going to hit that ceiling of 5 properties. With the commercial, there is no real ceiling. The bigger challenge is going to be proof of funds, proving to the lender where the money is coming from. It's becoming a bigger and bigger issue all the time. With the money laundering and the anti-terrorism rules, etc., the banks want to know where the money's coming from because the government forces the banks to disclose where the money's coming from. So in a case like this, you're going to have to prove where the money's been for 3 months prior to the deal actually taking place. So what some people will do is they'll actually take the money from the partner, the investor partner, and put it in their bank account for 4 months prior to application. The question is this mortgage fraud? It's a little bit of a gray area. Some people say it is, some people say it isn't. I'm not going to share my opinion on it. I do find it difficult, though, to believe that a money partner would be willing to advance their portion of the investment 4 months prior to the deal coming into play, simply so the money can be sitting there for 3 months prior to the application for financing. Has it been done? Yes, I have seen it done this way. But again, the question is it mortgage fraud? So that leads us into what exactly is mortgage fraud? Well, it's the criminal act of deceiving or intentionally misrepresenting information on the application so that a borrower can be approved for the loan. This type of fraud involves falsifying the earning statements. So in other words, saying that you earn more than you actually do, or disclosing more assets than what you actually do. It can also, this whole thing can lead to people qualifying for mortgages who shouldn't be qualifying for mortgages, and therefore increasing the risk factor dramatically. And this is what happened in 2007, 2008 with the mortgage crisis, the subprime mortgage crisis in the U.S. market in particular. What was happening there was a lot of mortgage lenders were putting people into mortgages that really had no business. I mean, everybody has the right to home ownership, absolutely. But some people just are not financially strong enough to be able to afford home ownership. Yet these creative mortgages allowed these people to get into a mortgage, and for a short term they could manage it, and with the idea that in a year or two, when they refinance that property at a higher value, they'd be able to get the lower interest rates. Well, this was just basically a house of cards that imploded, and that's what caused the subprime market, allowing all these people getting into the market who weren't or shouldn't have been in the market, and also lying on the statements. They didn't have good solid jobs, therefore they would just write in a number as to how much they would actually be earning and not have to prove it at all. So as a result, they've changed the rules for mortgage qualification and made it a little bit more difficult for people now. So you have to keep in mind that even to this day, there's some mortgage brokers and some lenders who may suggest non-disclosure or overstating of numbers, or suggest you do some side deals in order to qualify for a potential mortgage. Now, you have to realize that the mortgage broker is not going to be the one who suffers the consequences of mortgage fraud. It is going to be you that, if challenged and caught, will suffer the consequences of mortgage fraud. So you want to make sure that you stay on the right side of the law and just be careful and understand what it is you're actually doing. There's also, unfortunately, some mortgage lenders out there who will encourage you to enter into agreements that may not be in your best interest. It's actually in the better interest of the mortgage broker. So they could put you into a mortgage with a lender that's paying the mortgage agent a higher commission fee, but the rates and terms of the mortgage are not in your best interest. So you want to make sure that it's working for you and not for the mortgage agent. You want it to be fair on both sides. So bottom line is just be careful. All right, so that's it for the different sources of financing. The lesson number 3 is going to be about vendor takeback or seller financing. It's a lesson in of itself because it is probably the most creative one and the biggest opportunity for you as well. Again, if you have any questions, kbeaton@arcarealestate.ca, or if you can hold on to your questions until we do the live webinar with the Q&A review, that would be great. Please send your questions in ahead of time if possible, so it gives me a better opportunity to put together the proper answer for those questions. All right, look forward to seeing you in lesson number 3. Take care now.